This is the Phelan and Myers 2 for 20 with the Willett, Phelan, Myers & Rotz Wealth Management Group of Janney, Montgomery, Scott. Janney, a member of FINRA, SIPC, and the New York Stock Exchange, maintains a presence in Duluth with their office at 6340 Sugarloaf Parkway, Suite 130, Duluth, Georgia.
Good morning. This is Scott Phelan of Willett, Phelan, Myers & Rotz, and we bring to you our latest edition of Phelan and Myers 2 for 20. We've got two folks here with us, Lindsay Dendy of Dorsey Austin Realtors and Mark Pagamanakis of Goldwater Bank. We're going to talk about the state of the real estate market here in the city of Atlanta and also talk about this crazy mortgage market that we're experiencing. So, Lindsay, why don't we start with you? How long have you been selling real estate in Atlanta?
I've been selling real estate for over 20 years in Atlanta. Okay. I started my career with John Wheeland Homes, a builder around town, and then I went into general residential real estate. And
so now are you doing commercial or residential or both? Or
residential.
Mainly residential?
Mainly residential.
So what in the world is going on with this real estate market right now? I've never seen anything like it. I thought the 90s were crazy, and this is just unlike anything I've ever seen.
I agree. And in 20 years, I have never seen the multiple offer situation that we're experiencing right now. We've had an amazing spring market, and it continues to be strong. Even as interest rates are heading upwards, it's still a very strong real estate market.
Really? Despite the fact that, I think, Mark, tell me, the 30-year mortgage has gone from, high 2s to mid-6s now? Is that right?
That is roughly correct. Yeah, over the last year, we've seen an incredible increase in the rates, especially in the last 90, 120 days. It's been unpredictable. It hasn't been a steady rise. It's just there are certain isolated pockets of days where you can see the rate just jump. And that is very odd, very unique situation.
And so, Lindsay, you're saying that the real estate market, despite this jump in interest rates, is still going strong from what you've seen. I mean, are you seeing any slowdown in it necessarily?
So we're seeing a little bit of a softening of the market, whereas in the past you may have seen crazy multiple offers. It's a little bit more manageable now, which is actually really good news for buyers. But the inventory is very low, and there are a lot of buyers. So there's more buyers than there is inventory, and that is still the case.
Yeah. So if I came to you, I want to sell my house, and it's, $500,000 house as an example. So if I came to you, what is the process now? Because it seems like it's really hard to gauge a price, and even when you gauge a price in this example of $500,000, it could end up selling for $580,000, $600,000. So how do you handle this? What is the process that you go through to determine what you think it'll sell for, and then do you go 10% higher than what you think? How is it different now, for example, than it was 5 years ago?
So my advice is still to price the home properly. Still get your house for sale in the same way that we always have. You need to put your best foot forward, replace the carpet, do the paint, get the landscaping in order, present your home in the best light possible. Price it reasonably within the comparables. Don't price outside of the comparables, because you're going to price yourself out of the market. And there's no such thing right now, in my opinion, as pricing a home too low. Because if you go in, let's say all the comps are leading you to 450, you say, okay, I'm going to be at 450. If the market dictates, hey, that's amazing, you'll get multiple offers, and that price will get driven up more so than if you said, oh, okay, the last sale was 450, I'm going to go in at 500 and just try and push the market. It makes more sense to price it reasonably within the comps and then drive it up with multiple offers.
In how often do offers come in above the asking price? If you price it correctly, are they always coming in above asking or?
I would say, as always, it depends on location, the product, the price range. The lower price points, they are still getting multiple offers.
And then what about appraisals? Because if you have a house priced at, and again in this example at $500 and you get an offer at $600, but there's no comps to support that $600, how do you account for that in a contract?
So what a lot of buyers are doing right now is putting in what's called an appraisal gap. And the appraisal gap is something that the buyer will cover the difference between let's say an example is that the home appraises for $450 and they're under contract for $500. The appraisal gap that they can now add in will add a specific number that they determine up to their contract price. And so they would pay, in that example, they would say, okay, I'll pay $25,000 more than the appraised value. So they would then be at a $475 price point in that example. But I will tell you, it is very important as a realtor to me on the listing side to actually meet the appraiser at the property, to go over my reasoning of why we priced it the way that we did, to also say, listen, I had 10 offers here. Obviously, this is the right price point for this home. And I think appraisers are actually very receptive to that as we are in such an increasing market.
Now, Mark, I thought, though, that after 0809 that the appraisals became a little bit different, where you could have no contact with an appraiser. Am I wrong about that?
Technically, yes. I mean, there was a major change in the mortgage landscape in 2008, 2009. A lot changed. A lot of process changed, one of which was how appraisals were ordered, how they were processed, and the kind of influence that could be exerted on an appraiser. The intention of the law and the changes, the reforms, was to keep appraisers from being talked into an artificial value because they were they received a lot of business from a particular lender. Mm-hmm. So now there's an intermediary company that operates between the lender and any appraiser. But I don't think there's anything wrong with having an honest discussion with an appraiser over just the data that's available. I don't think that that's an influence. Again, as a lender, we do not communicate with the appraiser directly. Everything that we provide in terms of our request or any of the information that we want to challenge is all done through that intermediary. So there's always a third party involved to keep things as objective as possible.
I got you.
And as a listing agent, you do have to meet with the appraiser to allow them to have access to the house. And so you do have an opportunity to have a conversation. And in my experience, they've been receptive to, hey, this is how we came up with the price. Or possibly this is a home that sold that is not in FMLS.
Yeah. So are you seeing, what percentage of homes right now are you seeing cash offers for versus financing?
So it's interesting because what I'm seeing more than cash offers are homes that do not have a financing contingency. And that is why it's so important to work with your lender and be completely approved going into the offer so that you don't have to put in a financing contingency. And if you do have an appraisal contingency, it's a very short one. And that is the key to working very closely with your lender. So that is what I'm seeing more than cash offers. Now, if you have a cash offer, what I'm actually seeing is that they have the cash that they can show, but they have also included in that they have the right to get a loan. And you see that much more than just the all cash offer.
Mm-hmm. Yeah, I assume you agree with that, Mark?
I agree. You're my favorite real estate agent today.
Yay! Oh, thank you.
Yeah, it should be noted there are lenders out there that can fully underwrite the borrower before a property is identified. Not all lenders do this. My company does. But we can take the time on the front end to fully vet out the income, the assets, any of the unforeseens that might be involved in the transaction. And we can clean all of that up so that we are in a position when an offer is made that all we're really looking for is property-related items, the appraisal, the title work, and the insurance. That makes for a much more condensed process after you go under contract. Instead of waiting 21 to 30 days to go to closing, we could pull that off in roughly 10 days. So with every loan transaction, there is a process, but the timing of when we do what really does make a difference. So,
and so one thing that I've heard after the real estate mess of 2008, 2009 is that getting a loan, which frankly is a good thing because in 08, 09, or I guess really prior to 08, 09, they were giving loans to anybody. Mm-hmm. Stated income loans, which stunned me when somebody explained them to me, which is basically tell me what your income and your net worth is and we'll run your credit and we'll loan you money based on that. And I asked the mortgage guy, I said, you guys actually loan money like this? He said, yeah, it's our most popular product. So it's not surprising that the market crashed the way it did in 08, 09. But I hear not all the time, but from time to time, from clients that are going through the mortgage process, they say, this is a lot more difficult than it was 15 years ago. Can you just kind of explain what some of those differences are and what the impetus for them was?
Yeah, that's a great point. It is difficult to go through the mortgage process if you're unprepared. But I think, victory favors the prepared. So, it was definitely easier prior to the Great Recession to get a mortgage. There were a lot of products out there that were driven by things that lacked fundamentals, being credit worthy, having sufficient income, being able to validate the legitimacy of the information that you were provided. A lot of those things were absent. And again, I think that was just, it was a different time. The market was feeding on that frenzy. That was definitely, a mortgage-related crisis. Since then, the reforms that have been put in place, they're burdensome, and they've created a lot of additional cost. But you have to sort of pick, the challenges that you want to deal with. I don't think that there's anything that is unreasonable about asking a borrower to document their income or their assets. Are you good for it? You say you make X a month. We need to see it. That is the difference between stating your income and documenting your income. And sometimes, especially with self-employed borrowers, high net worth individuals, it's difficult to pull together a comprehensive application, which is what's required of us. Because there may be multiple income sources. There may be income sources that are difficult to document. There may be legitimate income sources that practically are available to pay bills, but the guidelines, the regulations don't allow us to consider that income as part of the transaction. So even though there are real dollars coming in, we can't put it on the application. So, a lot of that, again, I'll go back to my previous point. A lot of that, those are things that we can address early in the process. Our goal is to put the buyer in the best possible position. A large part of that is engaging with the lender prior to the contract. Getting a pre-qualification is the first step, but most people stop at the pre-qualification. The pre-qualification is just a verbal application that the lender processes through a piece of software that says, this is potentially a good transaction. That's a good first step. But getting pre-approved, getting a credit decision, having an underwriting decision, a credit offer letter in place from a lender that says, yes, we will lend on this, provided the property comes in as expected, that's much more powerful. That is something that is more attractive to a seller. That is something that, again, the seller, in most cases, doesn't care whether you finance the property or not. They just want to go to closing on the date of the contract. So, putting yourself in a position to where you've taken as much of the unknown out of the process as possible is key, especially in this market where, it is a seller's market.
Yeah. And so when did interest rates start moving up on mortgages? At the beginning of the year? It seems like
roughly
it was
the beginning of the year.
Okay.
Yeah.
So this time last year, 30-year mortgage is high twos?
Well, we had started to see a little bit of an increase about a year ago. We were still in very attractive rate territory. Generally speaking, over the last decade, rates have been in the 2.5% to 4.5% range, and that's relatively stable. I mean, we were in the mid to high threes about a year ago, but that wasn't, that had been fairly stable territory. Those were, rates that were in line with what had occurred 2 years ago. So we were in kind of, a boring rate movement. About the beginning of this year, we started to see some uncertainty. Again, a lot of this is not just isolated to one thing, but a large part of what was making this happen was, the Federal Reserve moving from, a quantitative easing standpoint to quantitative tightening. And again, I'm not an economist, but basically the Federal Reserve communicated that it was going to stop buying mortgage-backed securities. Well, because mortgage-backed securities still need to be bought by somewhere. They need to be bought by an investor, and that investor was by and large the Federal Reserve for a very long time. Other investors out there, such as insurance companies or REITs or other institutional investors, were looking for a higher return on their investment. The Federal Reserve did not have necessarily a return in mind when it was buying mortgage-backed securities. It was doing it more for economic reasons. The alternative buyers of mortgage-backed securities of MBS they were looking for an investment return. So that naturally caused rates to increase. Again, nothing happens in a vacuum. That wasn't the only reason, but I think that was a large contributor to why rates have increased to where they are today.
So a 30-year mortgage today approximately is what rate-wise?
High fives, mid sixes.
Is that right?
Yes.
Okay. Wow.
Yeah.
What a move.
Yeah, there's a common misconception that there's just one rate. And there isn't one rate. There's a range of rates that are applicable depending on credit score, depending on your debt-to-income ratio, the type of property you're buying, whether you're buying it for investment purposes or second home or primary residence. So, rates will vary depending on all of those factors. There are adjustments to accommodate the risk in all of that. But, just recently, a couple of weeks ago, we started quoting rates in the sixes.
Really? Mm-hmm. No, are you seeing a lot of first-time home buyers priced out of the market as rates have gone up and as the price of houses have gone up so much? Are you seeing much of that come across your desk or not?
That's a great question. I think that's applicable to any market. When rates moved from 2.5% to 3%, there were people on the borderline at 2.5% that got priced out. So every increase in rate is relative. 90 days ago we quoted a rate at 5.25%, and that was considered quote unquote too high. But that same buyer would probably trip over himself or herself to get to that rate today. So in every market there are going to be people that are priced out. A lot of this is volatile because it's happened in a very short period of time. But we have a combination of factors. We have very low inventory. We've had very low historic housing starts for the better part of a decade, and we have a rising interest rate environment. So, it feels more common just because a lot of this is happening in a very short period of time.
So let's go back to you for a second, Lindsay. So
sure.
What's the hottest part of the Atlanta market right now, geographically? Is it in town? Would be my guess.
In town is extremely hot, as always. We have an influx coming from New York, California, I'm seeing primarily, and that is making that in-town market very strong. There are always going to be people that want to be close to the action, but the suburbs are also hot. Milton is one of the hottest areas. Milton, Alpharetta area is one of the hottest areas right now. And I think school drives that a little bit too. But the Atlanta market as a whole is very strong.
Yeah, it seems like inside the perimeter, a lot of people that have lived inside the perimeter are going out to the suburbs, but they're getting backfilled, like you say, from people from New York and California. So the whole area is hot.
That's right. And people from New York and California, our prices are extremely appealing to them. And so they want to be in town and they want to be close to all of the wonderful things that the city has to offer. And I think a lot of people during COVID especially kind of rethought their life that lived in town and said, hey, I think I'd like to, experience something outside of Atlanta.
So kind of as we get close to the 20-minute mark here, predictions going forward, Lindsay, and then I'll ask you, Mark. What do you think a year from now the real estate market in Atlanta looks like?
I think it still remains strong. I think that the interest rates at some point do have to soften this craziness that we're experiencing. But I think that inventory is still extremely low, and there's still many buyers out there, and I don't see that changing. Hopefully the interest rates will calm down and kind of remain where they are, and I think we're still in a great market.
Mark, prediction. Thank you, Lindsay. Mark, prediction on interest rates?
I think
a year
in
from
the
now?
short term we'll probably see a little bit of softening, but if I had to pick in one direction, I don't see 3%, 4% rates coming back anytime soon. I think a year from now it is more likely that we'll be in the sixes than that we'll be in the fives. That's my prediction. As long as scarcity creates value, as long as there's a continued shortage of housing, if inventory is not plentiful in the market, there's still going to be a seller's market. I'm seeing a little bit more inventory out there than a year ago, but as far as interest rates go, I think unless the Federal Reserve or some other governmental factor intervenes, the market is going to demand a higher interest rate than what we've seen historically.
Okay, I got you. Well, thank you guys. And one last disclaimer, to keep my compliance folks happy. Mark, you in the mortgage business, Lindsay, you in the real estate business, we have no connection with Janney Montgomery Scott. You guys have your independent practices. So I just have to say that to keep my compliance folks happy. So thank you guys for updating us on the real estate market, the mortgage market here in Atlanta, and till next time.
Thank you.
The information provided here is taken from sources which we believe to be reliable, but the accuracy and completeness of such information is not guaranteed by us. This is not an offer to sell or a solicitation of an offer to buy any securities. Opinions expressed are subject to change without notice and do not take into account the particular investment objectives, financial situation, or needs of individual investors. Employees of Janney Montgomery Scott, LLC, or its affiliates may at times release written or oral commentary, technical analysis, or trading strategies that differ from the opinions expressed here. Investing may involve market risk, including possible loss of principal. Janney Montgomery Scott, LLC, its affiliates, and its employees are not in the business of providing tax, regulatory, accounting, or legal advice. Any tax-related statements are not intended for and cannot be used or relied upon by any such taxpayer for the purpose of avoiding tax penalties. Any such taxpayer should seek advice based on the taxpayer's particular circumstances from an independent tax advisor. For more information about Janney, please see Janney's Relationship Summary, Form CRS, on www.janney.com/CRS, which details all material facts about the scope and terms of our relationship with you and any potential conflicts of interest.